Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. One
Welcome
page
again
at a time till
to
the
our study
whole
time.
believes.
Today, let's go ahead and get into our class right away.
May He give you wisdom, critical thinking too. Let it rise in you. Come.
All right, it's time to start. So let's get it going. Today is already Tuesday, June the what? The 16th? Wow. Time is going by really fast. Okay. Praise the Lord. All right, our first question. How are dividends per share for common stock used in the calculation of the following? How are dividends per share for common stock used in the calculation of the following? Dividend per share. How are they used? How do you use dividends per share in the calculation of dividends per share payout ratio and earnings per share? Dividends per share payout ratio. Let's go with this first. Okay. Let's go with dividends per share payout ratio first. Give me just a second. Let me scan this real quick. Okay. So first, dividends per share payout ratio. The formula dividends per share payout ratio is dividend per share divided by earnings per share. The question asks, how are dividends per share for common stock used in the calculation of the following? Or in the when you're calculating, let me just rephrase that. When you are calculating dividends per share payout ratio, how do you use dividends per share for common stock? All right. Dividends per share for common stock is used in the numerator, because if you say you're calculating dividends per share payout ratio, the formula is dividends per share divided by earnings per share. So dividends per share, when you are calculating dividends per share payout ratio, dividends per share is the numerator. The second one is earnings per share. How do you use dividends per share in the calculation of earnings per share? The formula for earnings per share is net income minus preferred dividends. Net income minus preferred dividend divided by weighted average of common stock outstanding. So in this formula, we do not have dividends per share for common stock. We have dividends per share for preferred stock, which is the numerator, but we do not have dividends per share for common stock. So dividends per share for common stock is not used in the calculation of EPS, in the calculation of earnings per share. So here we have the answer. To calculate dividends per share payout ratio, dividends per share is the numerator. To calculate earnings per share or EPS, dividends per share for common stock is not used. Okay. At the end of its fiscal year, Christ Inc. had the following account balances. So what I love to do is to go all the way down to see what the question is. The question says, what is Christ quick or acid test ratio? So we're looking for acid test ratio. We are looking for quick ratio. So quick ratio, and we already know how to calculate quick ratio. Okay. So here is the account. Here is the balance. We have cash, $5,000, accounts receivable, $10,000, inventory, $20,000, total current assets, $35,000, accounts payable, $15,000, total current liabilities, $20,000, long-term note payable, $35,000. What is the question? What is Chris quick ratio or acid test ratio? So we need to calculate the quick ratio. What is the formula to calculate quick ratio? It's quick asset divided by current liabilities. That's the formula to calculate acid test ratio or quick ratio. The formula is quick assets. Okay, not current asset, but quick assets divided by current liabilities. Why do we say quick asset? Quick asset does not include inventory. Quick asset does not include inventory. You know that inventory is an asset. Yes, inventory is an asset, but when you're calculating quick asset, that means something that can be converted into cash right away. You do not include inventory. Inventory is not part of it. All right, so what do we have as quick assets here? Is cash, accounts receivable, cash, accounts receivable, inventory, total current asset, accounts payable, total current, and that's it. That's all we have as quick assets. So what we're gonna do is cash is $5,000. Accounts receivable is $10,000, so that's $15,000. Quick asset divided by current liabilities. And then we have total current liabilities is $35,000, so divided by $35,000. So this is going to be 0.42. 0.42. And the answer is 0. Wait. I have something different. 15,000 divided by total current. Oh no, I'm sorry. Total current, where did I have long-term? Oh no, okay. Total current assets, no. Total current liabilities is $20,000. Total current liabilities is $20,000. So $15,000 divided by $20,000 is 0.75. And that's correct. 0.75. Okay. Redwood Co's financial statements had the following information at year end. All right, that's the same type of question. So let's go all the way down to see what the question is. What was Redwood's quick ratio, which is the same thing. We're calculating quick ratio again. Quick ratio has another name, acid test ratio. Okay. So we have cash, $60,000, accounts receivable, $180,000, allowance for credit losses, $8,000, inventory, $240,000, short-term marketable securities, $90,000, prepaid rent, $18,000, current liabilities, $400,000. Long-term debt, $220,000. Now we need to calculate quick ratio. Okay, so how do you calculate quick ratio again? It is quick assets divided by current liabilities. Okay, to calculate quick ratio or acid test ratio, it is quick asset, not current asset, but quick assets. Okay, current assets would include inventory, would include prepaid rent. Okay, but current asset, quick assets does not include that. Okay, so quick asset is cash, accounts receivable. Here we have short-term marketable securities. Yes, we need to include short-term marketable securities as quick asset. Okay, so let's calculate this. Cash is $60,000, 60,000 plus accounts receivable 180,000 plus short-term marketable securities $90,000 plus 90,000. Here we have $330,000 as quick assets. Okay, so quick assets $330,000. Current liabilities is $400,000. So 330,000 divided by 400 or 400,000. That's 0.82. 0.82. So here we have two answers that look alike. We have 0.81 and 0.83. So since it is 0.82, we will select 0.81 because it's closer to 81 than 83. Well, I don't think so. 0.82.5. It's gonna be one of them, but this is really tricky. Let me get some insight on this because this is tricky. 2 is close to 1. It's also close to 3. So which one should you select? All right, for the answer, we have two answers that could be. It could be 0.81. It could be 0.83. The answer I found is 0.82 or 0.825. Why would I select 0.81, not 0.83? This is a great FAR exam question because it teaches an important CPA exam rule. If your calculating answer falls exactly between two choices, pick the one closest to the unrounded calculation. You mentioned your calculation came to about 0.8825. Now compare the answer choices. 0.81, 0.83. Distances 825, minus 81 is 0.015. 0.83 minus 0.825 is 0.005. Mathematically, 0.83 is closer. So if your exact ratio truly is 0.825, then 0.83 should be selected. Most likely one of three things happen. Possibly your numerator is off. Many students accidentally include or exclude something incorrectly. For example, included prepaid rent. No, I didn't include anything like this. So based on your calculation, what is the answer? Based on, therefore, however, all right. Okay. Let's do it. Yeah, we need to make sure we are sharp with this, because if you get a trick like this in an exam, how do you select the right answer? Cash 60, yeah, we got this. 0.805. 333, 322. What did I have? Why do you have 322? 330. I have 330. Where did you get 322 from? Just a second. Let me see. Quick asset, yes, identify quick assets. Cash $60,000, accounts receivable $180,000, loss, less allowance for credit loss. Oh, less allowance for credit loss, $8,000. Plus short-term marketable securities, $90,000. So I was missing this part. All right, we have allowance for credit loss. Explain to me, why do we subtract allowance for credit loss? This is one of those FAR concepts that becomes easy once you understand the story behind it. Imagine you own a business, you sold products on credit. Customers owe you $180,000. So accounts receivable shows $180,000, but then management looks at the customers and says, wait a minute, some of these people probably won't pay us. Maybe they estimate $8,000 will never be collected. All right, so they estimate that $8,000 will never be collected. The real question, if I show up at your office today and ask, how much cash do you realistically expect to collect? Would you say $180,000? No, because you already know about $8,000 is probably bad. It's uncollectible. You would say, $180,000 minus $8,000. So that would be $172,000. That's the amount you expect to turn into cash. I see. What is the allowance account? The allowance is a contra asset. Think of it as a negative asset, right? Asset, account receivable, loss allowance, net receivable. Okay. All right. So why does the quick ratio use net accounts receivable? Remember what the quick ratio measures. If I need cash quickly, how much liquid asset do I really have? The quick ratio does not care about fantasy money. It cares about money you can actually collect. So gross account receivable $180,000, net accounts receivable $172,000. Think like a banker. Suppose you go to a bank, you say, I have $180,000 in receivables. The banker asks, will everyone pay? You answer, actually about $8,000 is probably uncollectible. The banker immediately values your receivables at $172,000, not $180,000, because the bank wants the realizable value. Okay, so exam shortcut, whenever you see accounts receivable, allowance for credit losses, allowance for doubtful accounts, immediately think net accounts receivable equals accounts receivable minus allowance. Use net accounts receivable for current ratio, quick ratio, working capital, total assets. Okay. Use net accounts receivable for current ratio. Even though you're calculating current ratio, you need to use net accounts receivable. Okay? Net accounts receivable equals accounts receivable minus allowance. All right? Use net accounts receivable for current ratio, quick ratio, working capital, total assets. Because GAAP reports receivables at their net receivable value. Okay, that's good. All right, excellent. Now I see why. All right, it's 0.81. I see what happens. Okay. Selected data pertaining to lower cool for year 4 is as follows. All right, so I'll go all the way down. What's the question? What is Laura's inventory turnover ratio for year 4? So now we need inventory turnover. Inventory turnover is cost of goods sold divided by average inventory. That's the formula. Okay. So net cash sales is $3,000. Cost of goods sold, $18,000. Inventory at beginning of the year, $6,000. Purchases, $24,000. Accounts receivable at beginning of year, $20,000. Accounts receivable at end of year, $22,000. So now, what is inventory turnover ratio for year 4? I could take some time to think through it, but let me do that for the sake of time. Okay. Sake of time, let's do this. Alright, so what is the formula? Inventory turnover, cost of goods sold, divided by average inventory. The moment you see inventory turnover, think cost of goods sold divided by average inventory. Step 2, find ending inventory. Alright, use the inventory equation. I have to take this call. Should I? Hey. Hello?
Hello, this is your callback. If this is Will Ken,
I had to take this call. Yes.
and you're ready to speak with a representative, press 1. If you no longer need to speak to a representative, press 2. If you would rather... Please hold. A representative will be with you shortly.
Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. One page at a time till the whole room believes. May God give you intelligence. May He give you wisdom. Critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp. With a great memory. Oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Hey! Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp. With a great memory. With a great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Amen. Amen. Come and study with me. 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 You've got what it takes. You've got what it takes. You've got what it takes. May your brain be so sharp. With a great memory. With a great memory. May you pass every exams. Come study with me. Come study with me. Come and study with me. Come study with me. Let's master our craft. Let's work on our dreams. Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. Oh, one page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. Oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. With a great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. May He give you wisdom. Critical thinking too. Amen. Amen. Come and study with me. 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 You've got what it takes. You've got what it takes. You've got what it takes. May your brain be so sharp, with a great memory. With a great memory. May you pass every exams. Come study with me. Come study with me. Come and study with me. Come and study with me. Let's master our craft. Let's work on our dreams. Come study with me.
Yes, let me try to call her.
Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. Oh, one page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. Oh, come and study with me. Come study with me.
I'll tell her. So does she need to do it right now, or
May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna takes, you can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Hey! Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp. Ooh, with the great memory. With the great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Amen. Amen. Come and study with me. 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 You've got what it takes. You've got what it takes. You've got what it takes. May your brain be so sharp. Ooh, with the great memory. With the great memory. May you pass every exams. Come study with me. Come and study with me. Come and study with me. Come and study with me. Let's master our craft. Let's work on our dreams. Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. Oh, one page at a time till the whole room believes. May God give you intelligence. May He give you wisdom. Critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes.
All right, I had to take that call. I had to take that call. All right, exactly 10 minutes. All right, cool. Let's keep going. Okay. Let's keep going. Ooh. Okay, so we said selected data pertaining to lower core for year 4 is as follows. The question is, what is lower? Lowe's inventory turnover ratio for year 4. Am I receiving another call? Hello? Yes. Okay. And yes, so let's give it an hour, please. Oh, I see. Okay, thank you very much. Excellent. Thank you for your call. Okay. You're welcome. Okay, bye. Okay. All right, so this was a very important call that I had to take. All right, so we say that selected data pertaining to law call for year 4 is as follows. Net cash sales, $3,000. Cost of goods sold, $18,000. Inventory at beginning of year, $6,000. Purchases, $24,000. Accounts receivable at beginning of year, $20,000. Accounts receivable at end of year, $22,000. Okay. The question asks, what is Laura's inventory turnover ratio for year 4? So we already know the formula. Inventory turnover ratio is cost of goods sold divided by average inventory. All right, so let's cost of goods sold divided by average inventory. Step 2, find ending inventory. Beginning inventory plus, use the inventory equation. Beginning inventory plus purchases minus cost of goods sold. Plug in the number. Beginning inventory plus purchases minus cost of goods sold. Beginning inventory, net cash, cost of goods sold, inventory at beginning inventory 6,000 plus purchases 24,000 minus cost of goods sold 18,000, okay, equals 12,000. So ending inventory is $12,000. Step 3, find average inventory. Average inventory is beginning inventory plus ending inventory divided by 2. So average inventory is $9,000. Step 4, calculate inventory turnover. We already know the formula. It's inventory turnover is cost of goods sold, which is $18,000, divided by average inventory, which we just calculated, $9,000. So it's 2.0, or let's say 2. Okay? So let's go through this again to understand this better. All right, so let's reflow that. Reflow it. Yes, we know that inventory turnover ratio is cost of goods sold divided by average inventory. So from there, give me a detailed explanation of what we are doing to get to the result. I need a nice flow. All right, step 1, what is inventory turnover asking? The question is not asking how much inventory do we have. The question is asking how many times did we sell through our inventory during the year. All right, so how many times did we sell through our inventory during the year? Think of a grocery store. If a grocery store starts with $6,000 of inventory and sells through it quickly, replacing it over and over, inventory turnover will be high. If inventory sits on the shelves all year, turnover will be low. That's why the formula is Inventory turnover equals cost of goods sold divided by average inventory. Cost of goods sold tells us how much inventory left the shelves. Average inventory tells us how much inventory was sitting there on average. All right, how much inventory was sitting there on average. Step 2, what do we already have? We know beginning inventory $6,000, purchases $24,000, cost of goods sold $18,000. Step 3, why do we need ending inventory? The formula needs average inventory. Average means beginning inventory plus ending inventory divided by 2. So that's why we need ending inventory, and ending inventory was not provided. Okay? We already have beginning inventory. We don't have ending inventory. Therefore, FAR expects us to calculate it. Step 4, how do we find ending inventory? Think physically. Okay? At the beginning of the year, $6,000 of inventory is on the shelf. At the beginning of the year, we already had $6,000 of inventory on the shelf. During the year, we buy $24,000. This is purchases. We buy for $24,000 more. Now available for sale is $6,000 plus $24,000 equals $30,000. During the year, customers purchase inventory that cost us $18,000. That inventory left the shelf. Okay? So what's left? $30,000 minus $18,000, that's $12,000. Ending inventory is $12,000. Wow, this is beautiful. All right, so I have net cash sales. I have sales, cost of goods sold. I have cost of goods sold. This is the cost of inventory that I have sold. Inventory at the beginning of the year is $6,000. So, and at the beginning of the year, I already had $6,000 of inventory. And then we purchased for $24,000 more. So how much money of inventory do we have available? It's $24,000 of purchases plus beginning inventory that has already been on the shelf. So we have $30,000 of inventory to be sold. Accounts receivable at the beginning of year, accounts receivable at the end of year. Now, here's what happens. We had $30,000 of inventory to be sold. And cost of goods sold is $18,000. That means during the year we sold for $18,000. How much is left from the $30,000? So from the $30,000, we have $12,000 left, which becomes the ending inventory. This is what's left on the shelf. So that's the ending inventory. So now we have beginning inventory $6,000, ending inventory $12,000. That's good. Ending inventory $12,000. Okay, that's pretty good. So calculate average inventory. Beginning inventory is $6,000. Ending inventory is $12,000. So average inventory is $6,000 plus $12,000 divided by 2. Beginning inventory plus ending inventory divided by 2. So once we have that, we can calculate the turnover. Okay. The turnover is cost of goods sold divided by average inventory, which is 18,000 divided by 9,000. That makes sense. Okay. Which is 2. All right. Term called reported inventory of $135,000, net sales of $700,000, and gross profit of $325,000. What was term's number of days in inventory? Now we need to calculate days inventory. This is a new concept. Let's go ahead and scan this. Okay. All right, so let's solve it using the same thought process. Step 1, what is the question asking? Number of days in inventory. This is asking, on average, how many days does inventory sit before it is sold? The formula is days in inventory is 365 divided by inventory turnover. So our first job is to find inventory turnover, right? Because we 365 is already a number. So we need to find inventory turnover. Step 2, find cost of goods sold. Because to find inventory turnover, we need cost of goods sold. Because the formula for inventory turnover is cost of goods sold divided by average inventory. Okay? Cost of goods sold divided by average inventory. Now, what we don't have cost of goods sold, we need to find it. We are given net sales. Net sales is $700,000. Gross profit is $325,000. Remember, gross profit equals sales minus cost of goods sold. All right, gross profit equals sales minus cost of goods sold. Okay, gross profit equals sales minus cost of goods sold. Remember that. Gross profit equals sales minus cost of goods sold. Gross profit equals sales minus cost of goods sold. Therefore, 325,000, which is gross profit. So we have that reported inventory of 135,000. Net sales is 700,000 and gross profit is $325,000. So gross profit equals sales minus cost of goods sold. We have gross profit, which is 325,000. We have sales. Sales is 700,000 minus cost of goods sold, which is what we do not have. So we will inverse it, reverse it, solve for cost of goods sold. Now, cost of goods sold equals 700,000 minus 325,000. So that equals 375,000. Okay. So now we have cost of goods sold. Okay, why did we need cost of goods sold? Is because the question asks us to calculate number of days in inventory. And number of days in inventory, the formula is 365, which is 365 days in a year. Sometimes they may give you a year of 360 days, 60 days. You will use that, but generally it's 365 divided by average inventory. Okay, so now we need to find average inventory. Average inventory is cost of goods sold divided, no. All right, average inventory equals, wait. Average inventory. No, wait. Days in inventory equals 365 divided by inventory turnover. Okay, inventory turnover. Now, to find inventory turnover, we need to find cost of goods sold because the formula for inventory turnover is a cost of goods sold divided by average inventory. So now we need to calculate cost of goods sold. What is the formula to find cost of goods sold? The formula is gross profit equals sales minus cost of goods sold. Gross profit equals sales minus cost of goods sold. So cost of goods sold, we have gross profit, we have sales, so we can calculate cost of goods sold. So cost of goods sold equals sales minus gross profit. Okay? Sales minus gross profit. So we go ahead, we just plug in the numbers. So now we have cost of goods sold. Step 3, find inventory turnover. Inventory is 135,000. Since only one inventory number is given, FAR assumes that is the average inventory. Inventory turnover equals 375,000 divided by 135,000. Remember this, in step 3, we need to find inventory turnover. So they gave us inventory, reported inventory of $135,000. To find inventory turnover, we need cost of goods sold divided by average inventory. To find average inventory, we need beginning inventory plus ending inventory divided by 2. But now we do not have ending inventory, and here is what it says. Since only one inventory number is given, FAR assumes that this is the average inventory. So cost of goods sold is 375,000. Average inventory is 135,000, which is 2.78. Okay, so convert turnover to days. Days in inventory, 365 divided by 2.78 divided by inventory turnover. 365 divided by inventory turnover, and inventory turnover is 2.78. So 365 divided by 278, it's 131.4. So 131.4 days. All right. Whenever you see inventory turnover, cost of goods sold divided by average inventory. Days in inventory is 365 divided by inventory turnover. Okay. All right. So in this question, why do we assume that the 135,000 is average inventory? Why don't we solve for ending inventory? Or since we don't know if 135,000 is in beginning or ending, so it does not mention if it's a beginning or ending inventory. Is this the reason why we don't solve for either one? Exactly. You're thinking about this, about it the right way. All right. So the exam follows very important rule. If a ratio requires an average balance, but only one balance is provided, assume that balance is the average balance unless the question gives enough information to calculate an average. Let's apply that rule here. What the question gives us: inventory is 135,000, net sales is 700,000, gross profit 325,000. Notice what's missing: beginning inventory, ending inventory, purchases. Since we don't have those numbers, we cannot calculate ending inventory. Could 135,000 be ending inventory? Maybe. Could 135,000 be beginning inventory? Maybe. Do we know? No, we don't know. The question simply says firm reported inventory of 135,000. Since it does not specify beginning or ending, FAR assumes that this is the inventory amount to use in the ratio calculation. In effect, average inventory equals 135,000. That makes sense. Okay. All right. All right, cool. Mm, 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 mm. 131 4. So days in inventory equals gross profit net sales minus cost of goods sold. Days in inventory, ending inventory divided by cost of goods sold divided by 365. Okay. All right. Days in inventory calculates the number of days it will take a company to sell its existing inventory on hand at year end. It is calculated as ending inventory. Well, I believe I love the other one more than this one. Yeah. Days in inventory is 365 divided by average inventory. All right. 365 divided by average inventory. I love this better. No. 365 divided by inventory turnover. No, not average inventory, but inventory turnover. All right, 365 days in inventory, 365 divided by inventory turnover. I need inventory turnover. What is the formula? It's cost of goods sold. All right, inventory turnover is cost of goods sold divided by average inventory. Do we have cost of goods sold? No, we don't have cost of goods sold. We can calculate it. So gross profit equals sales minus cost of goods sold. Gross profit equals sales minus cost of goods sold. So cost of goods sold becomes sales minus gross profit. Okay, sales minus gross profit. And then we can find cost of goods sold, and we follow the pattern to just calculate it. All right. All right, inventory turnover. Cost of goods sold divided by average inventory. Inventory turnover, cost of goods sold divided by average inventory. Days in inventory is 365 divided by inventory turnover. Days in inventory is 365 divided by inventory turnover. Or you can combine them in one formula. 365 times average inventory divided by cost of goods sold. If this is going to confuse you, don't even think about it. Okay? But you can do that. All right, cool. Let's move on to the next one. A company reported the following balances at year end. What's the question? What was the company's number of days sales in accounts receivable? Days sales in accounts receivable. A company reported for the following balances at year end. Accounts receivable, 150,000. Allowance for credit losses, 10,000. Credit loss expense, 15,000. Sales, 450,000. We are looking for number of days sales in accounts receivable. What does that even mean? What does it mean? Let's see. All right, the question is very similar to the inventory question, except now we are dealing with accounts receivable. Let's build the logic. What is days sales in accounts receivable? It asks, on average, how many days does it take to collect from customers? Okay. How many days does it take to collect from customers? We will still be doing the 365 divided by accounts receivable turnover. 365 divided by accounts receivable turnover. So first we need accounts receivable turnover. Step 2, what is accounts receivable turnover? It is net credit sales divided by average net accounts receivable. All right, net credit sales divided by average net accounts receivable. Accounts receivable turnover is net credit sales divided by average net accounts receivable. Notice the similarity. Inventory ratio, receivable ratio, cost of goods sold, credit sales, average inventory, average net accounts receivable. Okay. Inventory ratio, when you're calculating inventory ratio, this is similar to receivable ratio. Cost of goods sold is credit sales. Average inventory can be compared to average net accounts receivable. Which numbers matter? That's step 3. What are we given? We are given accounts receivable, which is $150,000. Accounts receivable $150,000. Allowance for credit losses $10,000. Credit loss expense $15,000. Sales $450,000. The trap is the credit loss expense. Ask yourself, does credit loss expense affect how much customers currently owe us? No. It affects income. For turnover ratios, we care about the receivable balance itself. Step 4, calculate the accounts receivable. Remember the lesson from the quick ratio question. Net accounts receivable equals accounts receivable minus allowance. Yes. Net accounts receivable equals accounts receivable minus allowance. So we need net accounts receivable. So 150,000 minus 10,000 equals 140,000. Net accounts receivable is 140,000. Step 5. Why use 140,000 as average accounts receivable? Same reason as the inventory question. The problem only gives one accounts receivable balance. It does not give beginning accounts receivable, ending accounts receivable. Therefore, FAR assumes that average accounts receivable equals 140,000. Remember that. Step 6, calculate accounts receivable turnover. So it's 450,000 divided by 140,000. It's 3.214. Step 7, calculate days sales in accounts receivable. Okay, days sales is 365 divided by 3.214, which is 113.6. Do we understand that? Okay. Now give me a clean flow coming from Just a second. Coming from days sales in accounts receivable equals 365 divided by accounts receivable turnover. Give me a clean flow without much explanation so that we can follow the flow easily. Yeah. All right, so days in accounts receivable, days sales in accounts receivable equals 365 divided by accounts receivable turnover. Formula 2. Now we need to calculate accounts receivable turnover. Accounts receivable turnover equals net credit sales divided by average net accounts receivable. Remember, accounts receivable turnover equals net credit sales divided by average net accounts receivable. Find net accounts receivable. Net accounts receivable equals accounts receivable minus allowance. Okay? Net accounts receivable equals accounts receivable minus allowance. All right? Or allowance for credit loss. Allowance for credit loss minus allowance. Okay? Repeat that. Net accounts receivable equals accounts receivable minus allowance. So accounts receivable, we have that. It is 150,000 minus 10,000, which is allowance for credit loss. This is where we find 140,000. Average net accounts receivable, only one balance given. Average net accounts receivable equals 140,000. The reason it's because they only give one. They do not mention if it is beginning or ending accounts receivable. So it is considered to be the average accounts receivable. Accounts receivable turnover equals sales divided by average net accounts receivable. Do we have sales? Yes. Sales is 450,000 divided by 140,000. Okay? So accounts receivable turnover is sales divided by average accounts receivable. Okay? Average net accounts receivable. All right? So accounts receivable turnover equals sales divided by average net accounts receivable. And you know the net accounts receivable is accounts receivable minus allowance, which is the 140,000. So we have 3.214. Now we need to calculate days sales in accounts receivable. Days sales in accounts receivable equals 365 divided by accounts receivable turnover. Accounts receivable turnover is 3.214. This is where we find the 113.6. Okay? Remember that. Days sales in accounts receivable. Days sales in accounts receivable. This is the chain. Accounts receivable turnover, average net accounts receivable, accounts receivable minus allowance, and then we have the answer. So that's what it is. All right, let's go. Let's go. Let's keep going. A company has income after tax of $5.4 million. interest expense of $1 million for the year, depreciation expense of $1 million, and a 40% tax rate. What is the company's times interest earned ratio? Times interest earned ratio. Let's go. Let's do it. Times interest earned ratio. Hello, hello. Now we are in Georgia. We are in Georgia, my friend. Yep. No, I'm not in California. I'm in Georgia. Oh, am I studying for CA? Oh, CPA. Well, I'm studying for the CPA exam. What is CA? I'm studying for the CPA. But this is far, right? This is far for CPA exam. Yeah. What does CA mean? What does it stand for? Oh, credit accountant. Maybe it's the same thing. Well, CPA is certified public accountant. Yeah, maybe it's called differently. Where are you? Where are you located? Yeah, maybe it's called differently, but they call it CPA, certified public accountant. Yeah. All right. Well, thank you. Okay, so let's get the next one. A company has income after tax of $5.4 million, interest expense of $1 million for the year, depreciation expense for $1 million, and a 40% tax rate. What is the company's time interest earned ratio? All right, so this is something we need to scan real quick. Gotta scan that. So that we don't spend time on it. Okay. So the question is, what is the company's times interest earned ratio? Company's times interest. All right, so let's rewrite everything, and the formula, put it vertical so that the whole thing can appear on the screen. Let's do it. Okay. EBIT interest expense. All right, so here's what we got for this one. Step 1, what is the formula? Times interest earned equals EBIT divided by interest expense. EBIT means earnings before interest and taxes. All right, EBIT, earnings before interest and taxes. What are we given? Income after tax is 5.4 million. Income after tax 5.4 million. Interest expense is 1 million. Tax rate is for 4%, 40%. Depreciation is 1 million. Depreciation is a distractor. Okay, remember that. In this question here, depreciation is a distractor. They just want to distract you. Times interest earned uses EBIT, not EBITDA. No depreciation in amortization. So it only uses EBIT. So step 3, convert income after tax to income before tax. Income after tax divided by 1 minus tax rate. So income after tax is 4.5 million divided by 1 minus tax rate. So that's going to be 0.60. That's 9. Income before tax is 9 million. Income before tax is 9 million. Step 4, convert income before tax to EBIT. EBIT equals income before tax plus interest. Okay. So 9 million plus 1 million is 10 million. So EBIT is income before tax plus interest. Okay, income before tax plus interest. You know what EBIT means? It's earnings before interest and taxes. EBIT is earnings before interest in taxes. So that means when you have EBIT, you have the earnings minus interest and tax. Okay, so if you want to, all right, so EBIT is earnings before interest and taxes. So now what we need, all right, convert income before tax to EBIT. Income before tax to EBIT. EBIT equals income before tax plus interest. All right, so 9 million plus 1 million is 10 million. EBIT equals 10 million. Step 5, calculate times interest earned. Times interest earned. 10 million divided by 1 million is 10. So a clean CPA flow. Times interest earned equals EBIT divided by interest expense. Okay, remember this is the formula. Times interest earned equals EBIT, earnings before interest and taxes. EBIT, this is what it means. Earnings before interest and taxes. All right, so times interest earned equals EBIT divided by interest expense. Now you need to find EBIT. EBIT equals income before tax plus interest expense. Okay, EBIT equals income before tax plus interest expense. Find income before tax. Income before tax is income after tax divided by 1 minus tax rate. Remember the flow. Remember the flow. Okay. So the flow is times interest earned. This is what we are calculating for. This is what we are solving for. Times interest earned equals EBIT divided by interest expense. EBIT divided by interest expense. We need to find EBIT. EBIT means earnings before interest and taxes. Okay. So find EBIT. EBIT equals income before tax plus interest. Find income before tax. Income before tax equals income after tax divided by 1 minus tax rate. So you plug in the numbers and then that's how you resolve the problem. So times interest earned is 10. for net income divide by 1 minus tax rate, add interest, get EBIT, divide by interest expense. All right, cool. That's good. So it's going to be 10. Excellent. Times minus interest minus earnings ratio, earnings before tax. Okay. I think that's good enough. A company reported the following for the current year. What's the question? What is the company's times interest earned ratio? Now we need to calculate the times interest earned ratio. All right, so we have revenue. Revenue is $400,000. Operating expenses, $175,000. Interest expense, $60,000. Income before income tax is $165,000. The company has a 30% effective tax rate. What is the company's times interest earned ratio? So it's almost the same question. So it's what is the company's times interest earned ratio? Let's go ahead and follow the flow again so we can calculate that. We got to be sharp in this because under pressure, this looks different. Okay, so let's use the same vertical flow. Step 1, the formula times interest earned. Times interest earned, EBIT divided by interest expense. Step 2, find EBIT. You are given income before tax. Interest expense is $60,000. Remember, income before tax is $165,000. Interest expense is $60,000. Remember, EBIT equals income before tax plus interest expense. All right, so EBIT, 165,000 plus 60,000 equals 225,000. Okay, income before tax plus interest expense. This is EBIT. EBIT equals income before tax plus interest expense. 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 EBIT equals interest before tax. Income before tax plus interest expense. EBIT equals income before tax plus interest expense. EBIT equals income before tax plus interest expense. Okay, we need to remember that. EBIT equals income before tax plus interest expense. So step 3, calculate times interest earned. What's the formula? EBIT divided by interest expense. Times interest earned equals EBIT divided by interest expense. Do we have EBIT? We do not have EBIT. EBIT means earnings before interest and taxes. Okay, so we need to find EBIT. We have interest expense. Interest expense is $60,000. We have that, but we do not have EBIT. We need to find it. So step 2, find EBIT. You are given income before tax. Income before tax is $165,000. We have interest expense, which is $60,000. We can find EBIT because EBIT equals income before tax, okay, plus interest expense. So now that we can find EBIT, it is easy to calculate times interest earned, because the formula for times interest earned is EBIT divided by interest expense. So EBIT equals 225,000. That's why we say to calculate times interest earned, we do 225,000 divided by what? By 60,000. Divided by 60,000. So that's where we get the answer. Which is what? Which is 3.8. Okay. 3.8. This is good. Okay. Well, my friend from India. All right. Well, I think they have different names. All right. So very cool. Very good. Very good. Let's we have 16 more minutes to go for our break. Let's keep going. All right. So the following calculations were made from Clay Cole's Year 1 books. Year 1 books. Number of days sales in inventory, 61 days. Number of days sales in trade accounts receivable, 33 days. Which one of the following was the number of days in Clay's Year 1 operating cycle? Which one of the following was the number of days in Clay's Year 1 operating cycle? Number of days. Clay's Year 1 operating cycle. Let's do it. This is testing the operating cycle formula. The formula for operating cycle, days in inventory plus what? No, wait. What does operating cycle mean? Think of the journey of $1. Cash, buy inventory. Inventory sits on shelf for 61 days. Sell inventory. Customer owes you money. Collect accounts receivable 33 days. Cash returns. The total journey is 61 plus 33 equals 94 days. So the operating cycle is the number of days from buying inventory until collecting cash from customers. Memory shortcut. Operating cycle equals inventory days plus receivable days. Okay, operating cycle OC equals DI plus DSO. Okay, operating cycle, which is OC operating cycle equals inventory days plus receivable days. Days sales outstanding. All right, so OC equals DI, which is inventory days, plus DSO, receivable days. Operating cycle equals days in inventory plus days sales outstanding. Days in inventory plus days sales outstanding. Operating cycle equals inventory days, days in inventory plus days sales outstanding. DSO, or receivable days. Remember that, okay? Operating cycle is 94. Okay, because what did we get? They gave us the number of days in inventory, okay, days in inventory plus number of days in trade accounts receivable, or days in receivable. All right, so 61 plus 33 is 94. Excellent. All right. Okay, let's keep going. Keep going. A company had the following items on its balance sheet at the end of current year. A company had the following items on its balance sheet at the end of the current year. Cash, $200,000. Accounts receivable, $330,000. Common stock, $150,000. $150,000. Prepaid expenses, $100,000. Deferred revenue, $75,000. Equipment, $1 million. Accumulated depreciation, $200,000. The amount of total liabilities at the end of the current year was $450,000. What is the company's total debt ratio at the end of the current year? Debt ratio, my friend. You remember the formula for debt ratio? Formula for debt ratio is total liabilities divided by total asset. Yes. Total liabilities divided by total assets. This is the formula for debt ratio. What is total liabilities? Cash, accounts receivable, common stock, prepaid expenses. These are deferred revenue, equipment, accumulated depreciation. The amount of total liabilities at the end of the current year is $450,000. We have total liabilities divided by total assets. Total asset is asset equals liability plus owner's equity. Okay, I need to remember that. So we have total liabilities. Do we have assets? Cash is asset, account receivable is asset, common stock is asset, prepaid expense is asset, deferred revenue, asset, equipment, accumulated depreciation. Okay. So depreciation is an asset? No, depreciation is not an asset. So we need to find total asset, and then okay. Let's see. Let's build the clean for flow. Step 1, what is the formula? Total liabilities divided by total assets. That's right. Debt ratio. Debt ratio equals total liabilities divided by total assets. Step 2, find total liabilities. We have it. Given deferred revenue is $75,000. Hey, deferred revenue is a liability. Deferred revenue is a liability. Total liabilities, wait, is $450,000. The question already gives you total liability. That's right. So total liabilities is $450,000. Step 3, find total assets. Add assets only. Cash, accounts receivable, prepaid expenses, equipment, Accumulated depreciation, oh, that's an asset. Net equipment, total assets, 200,000. Okay, step 4, ignore these. Common stock equity equals equity. This is equity. Deferred revenue, already included in total liabilities. Step 5, calculate debt ratio. 450,000 divided by 1,450,000. Okay. Total liabilities is 450,000. Total assets is I can't see the whole thing. Total liabilities divided by total assets. Okay. Total liabilities divided by total asset. All right, here I'm trying to see everything. Total assets 200,000 plus 350,000 plus 100,000 plus 800,000. I can't see the rest. So can we put it in smaller digits or verticals so that we can see the whole thing? Okay. All right, total assets, cash, accounts receivable, prepaid expense, equipment, accumulated depreciation, minus. Okay. Total asset, 1,450,000. Debt ratio, total liabilities, 450. Total asset, 1,450,000. Debt ratio. Okay. Oh, depreciation is minus. Minus depreciation, not plus. Okay, depreciation minus. Subtract depreciation. Okay. Subtract depreciation. When you have depreciation in the list and you want to find total assets, depreciation needs to be subtracted. Depreciation needs to be subtracted. Account depreciation 200,000 needs to be subtracted. But now, total assets. Asset equals asset line. Okay. Total asset. Liability is not an asset, okay? So remove that from your mind. Liability is different from asset. So total asset, you put all the assets together. Everything that's an asset, you put it together. And then total asset divided by, no, total liabilities divided by total assets. But if you see depreciation, you need to subtract it from total asset. Okay, depreciation, accumulated depreciation 200,000. You need to say minus 200,000. Common stock. Common stock. This is not considered as an asset. This is equity. All right, this is owner's equity. So you do not include it in total asset. So why don't we include common stock as an asset? Common stock. I know it's equity, but why isn't it considered as an asset? Okay. Yeah. Okay. Why don't we consider what's going on? All right, so why don't we consider common stock as an asset? Why isn't it an asset? I know it is owner's equity, but why don't we include it in assets? All right, so think about what an asset is. An asset is something the company owns or controls that provide future economic benefit. Example, cash, accounts receivable, inventory, equipment, buildings. These are resources the company owns. What is common stock? Common stock is not something the company owns. It represents the owner's claim on the company's assets. Think of it this way. Suppose you start a company, you contribute $100,000. The company receives cash. The company records cash $100,000, common stock 100,000. Okay? Notice cash is the asset $100,000. Common stock is the source of financing. Equity 100,000. The common stock did not create another asset. It merely explains the asset. Okay, where did the cash come from? Got it. Think of the balance sheet as a house. Assets, what is inside the house? Cash, equipment, inventory, receivable. Liabilities in equity, who paid for the house? Bank loans, liability. Owner investment, equity. Okay? So common stock tells us the owners paid for part of the assets. It is not another asset itself. It explains where the asset comes from. I would say that. The accounting equation, assets equals liabilities plus equity. Okay. Assets equals liability plus equity. If we counted common stock as an asset, we would be double counting. Example, owners contribute $100,000. If we treated both as assets, all right, so time for break. So let me finish this thought before we go to break. Let me finish this. All right, if we treated both assets equals assets 100,000 cash plus $100,000 common stock, but the company only received 100,000. I see. So the balance sheet would be wrong. Okay, makes sense. But another question I have here is assets equals liabilities plus owner's equity. If we are calculating total assets, all right, man. All right, so assets equals liabilities plus owner's equity. If we are calculating total asset, shouldn't we? Okay, I need to take this call. All right, I will be back. Hello? Yes, this is yes. Yes, let me try to call her again to see if she's able. In just a moment. You can still take a stand, no matter if you wanna be a CPA, MD, or RN. You got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical Come
study with me.
Non pas moi, on a.
When the
Entendez?
hours feel long, when
Ah.
the notes run deep. Oh, keep your eyes on the goal.
Oui,
Keep
non
your
téléphone,
promise to
non téléphone là avec
me. I give
Xfinity.
you intelligence.
You dit refresh
May
li
he
pou
give
ou,
you
c'est pour te
wisdom.
turn off the phone and turn it back on.
Critical thinking too.
Pour le cas pour un signal.
Amen, amen. Come and study with me. Come and study
Vous
with
entendez?
me. Come and study with me. Come and study with me. You've got what it takes. You've
Vous entendez?
got You've got what it takes. May your brain be so sharp. Ooh,
Hello?
with the great memory.
Yeah, I just called. I was able to find, but the call dropped.
Every exams, come study.
Yeah, I'm not sure.
Come and study with me. Come and study with me. Come and study with me. Let's master our craft.
Yeah, so I mean, she was able to pick up the call, but after she picked up, I'm sorry. Well, this time I was able to go through, but it dropped after about a minute.
Come study with me. Come study with me. We open the books and we keep our feet steady.
Alright, no problem.
Master our craft. Let's work on our dreams. One page at a time.
Alright, thank you very much. Yes, sorry, thank you.
May God give you intelligence.
Alright, thank you.
May He
Okay,
give you
appreciate it.
wisdom.
Okay,
Critical
bye.
thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes.
Alright.
You've got
Yeah, I'm
what
thinking
it
like,
takes.
oh, your team post you'll refresh everything, and you should be able to. Oh,
With the great memory. Oh, come and study with me.
oui, on a formé qui ouvre pour
May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp. Ooh, with the great memory. With the great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep. Oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Amen, amen. Come and study with me. 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 You've got what it takes. You've got what it takes. You've got what it takes. May your brain be so sharp. Ooh, with the great memory. With the great memory. May you pass every exams. Come study with me. Come and study with me. Come and study with me. Come and study with me. Let's master our craft. Let's work on our dreams. Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. One page at a time till the whole room believes. May God give you intelligence. May He give you wisdom. Critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp. With a great memory. Oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Hey! Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp. Ooh.
All right, we are back. Back to work. Back to work from break. It was a short break. I was on a call. Let's go. Let's do it. Okay. All right, so let's read the question again. Read the question again. A company had the following items on its balance sheet at the end of the current year. Cash $200,000, accounts receivable $330,000, common stock $150,000, prepaid expenses $100,000, deferred revenue $75,000, equipment $1 million, accumulated depreciation $200,000. Okay. The amount of total liabilities at the end of the current year was $450,000. What is the company's total debt ratio at the end of the current year? To calculate debt ratio, we need to do it. The formula is total liabilities divided by total assets. Okay? Total liabilities divided by total assets. This is how you calculate debt ratio. So we have total liabilities. All right, total liabilities is given to us, which is $450,000. So now we need to calculate. Total assets. We have all the assets here. We have cash, accounts receivable, common stock is not an asset. All right, cash, accounts receivable, prepaid expenses, deferred revenue could be considered liability but it's already calculated inside of the $450,000 of total liabilities. Equipment is an asset. Accumulated depreciation is a contra asset. Okay, accumulated depreciation is a contra asset, so you need to subtract it from total asset. That needs to be done. So you need to say minus 200,000. After you get all the assets, you need to say minus $200,000 of accumulated depreciation. Accumulated depreciation is a contra asset, so you need to subtract it every time you're calculating asset if it is present. All right. So let me go back. So now, in the calculation of total assets, we need to include every asset, all the assets, because asset equals liabilities plus equity. Liabilities plus equity. So now, to find total assets, what are the things that we need to include to find total assets? Knowing that the formula to find assets is liability plus equity. Okay. There are actually two ways to find total assets. Method 1, add all assets. This is what we usually do on FAR. On FAR questions, current assets, cash, accounts receivable, right? Net accounts receivable, inventory, prepaid expenses, marketable securities, other current assets, total current assets, okay? Non-current assets, equipment, buildings, land, intangibles, investments, accumulated depreciation, which is a contra asset, you will subtract it. Total non-current assets. Total assets equals current asset plus non-current assets. Method 2, use the accounting equation. If the question gives total liabilities and total equity, then assets equals liabilities plus equity. Example, liabilities 450,000, equity is 1 million, assets equals 450,000 plus 1 million, which is 1,450,000. Same answer. The key point, when you're adding assets, you include only accounts that are assets. Include cash, accounts receivable, which is the net accounts receivable. Okay, so net accounts receivable is accounts receivable minus allowance, inventory, prepaid expenses, marketable securities, land, buildings, equipment, net equipment, intangibles. Do not include accounts payable, notes payable, deferred revenue, common stock, retained earnings, treasury stock. These are liabilities or equity, not assets. Okay. I see. So the second formula, assets equals liabilities plus equity, is in the case if we are given total liabilities and total equity. Liability plus equity and total equity, so we can use this formula. If not, we just add all of the assets. Exactly, that's the way I would think about it on the FAR exam. Method 1, add all the assets. If the question gives individual accounts, cash, accounts receivable, inventory, prepaid, equipment, land, investment, then simply add the assets together. Example, cash, accounts receivable, we have all of them. So we add them all together. It gives you 1,450,000. Okay, makes sense. Method 2, use the accounting equation. If the question gives you total liabilities 450,000, total equity 1 million, then assets equals liabilities plus equity. Okay, makes sense. Makes sense. 1,450,000. But what are we calculating? What is the company's total debt ratio at the end of the current year? Oh, okay, so debt ratio. This is what we were calculating. Debt ratio is total assets, total liabilities divided by total assets. Okay? So we have total liabilities is 450,000 divided by 1,450,000. Okay, 450,000 divided by 1,450,000. Right? So that's 0.31 or 31.5%. 31%. Okay. That's correct. All right, this is good. This is good. Okay. Mm. 1,183. We have questions till 1,000. Financial statement ratio 72. Okay. Okay. We will end the live right now, and then we will come back tomorrow for another session. Okay. We'll come back for another session tomorrow. All right, everybody. Thank you very much for sticking around with me. Thank you so much, my friend from India, who been chatting with me. Thank you so much for the motivation. You say I will come back again and check on with you. Thank you so much. Appreciate it. All right, we'll be back tomorrow at the same time. Have a great day and be productive.